All right, let's talk byproduct accounting. I know, it can be a real headache. But what if I told you there's this super simple, kind of sneaky method that shows up all the time on exams and, in the real world? Today, we are going to master the sales method. My goal? To get you ready to totally crush this on your LCPA. Let's do this.
But okay, first things first. You are not going to believe this, but one of the most famous byproducts out there is Wendy's chili. Yeah, I'm serious. Think about it. When they cook those fresh, never-frozen burgers, what happens to the beef that gets a little too cooked or isn't shaped perfectly? They don't toss it. Nope. It becomes the star of their chili. So you've got a product with a lower value that's born from making the main product. And that, my friends, is a perfect real-world example of a byproduct.
Okay, so here's the game plan. First, we'll nail down what a byproduct actually is. Then we'll dive into this recognize it later method, what it is, and how to record the sale. We'll also cover why anyone even uses this simple approach. And finally, we'll wrap it up with a quick LECPA bullet review to make sure this stuff sticks. Let's get into it.
All right, first section. We got to start with the foundation. You can't really get the accounting if you don't get what the thing is.
So here's the textbook definition, but let's break it down. The key thing to remember is that you've got one big production process. You're making your main product. That's the star of the show. But along the way, something else gets created. And if that something else has a pretty small sales value compared to your main product, boom, that's a byproduct. Like when you're making lumber, you get wood chips. Or when you refine sugar, you get molasses. These aren't just trash, they're like little bonus revenue streams that can actually make a real difference to a company's profit.
Okay, listen up, because this is a huge exam trap. People always mix up byproducts and scrap. So let's make sure you never do that again. A byproduct has real, decent value. You might even spend a little more money to process it so you can sell it for more. Scrap, though, it has almost no value. You just sell it off as is right away for whatever you can get. Think about it. Valuable wood chips you can sell for landscaping, that's a byproduct. Sawdust you just sweep up and get rid of, that's scrap. Or a butcher. The good beef trimmings they sell for stew meat, byproduct. The bones and fat they sell for pennies, total scrap. See the difference?
All right, time for the main event, the sales method itself. And here's a little brain hack for you, okay? I want you to call this the recognize it later method. Seriously, burn that name into your memory because it literally tells you everything you need to know about how it works.
So if you walk away with just one single thing today, please let it be this. When you use the sales method, at the moment the byproduct is created, you do nothing. Absolutely nothing. You don't record any inventory, you don't assign any costs, you literally just wait. The accounting doesn't even start until the second that byproduct is sold.
And hey, don't think this is just some weird shortcut. This is a totally legit accounting method. I mean, the legendary Horngren cost accounting textbook spells it out right there. No journal entries until they're sold. The entire process has just one trigger, the sale. That's it.
Okay, so we're waiting. The byproduct is just sitting in a warehouse somewhere completely off the books. But what happens when we finally sell it? How does it actually hit the financial statements? Let's check it out.
Okay, this right here is your aha moment. Just look at the column for the sales method. See that line for the inventoriable cost of the byproduct, the wood chips? What's the number? It's a big fat 0. This shows our core rule perfectly. I mean, the company is physically holding all these wood chips, but on the balance sheet, their value is nothing. Not yet anyway. So until they're sold, these things have 0, and I mean 0 impact on the company's total inventory value.
And then, when that sale happens, the journal entry could not be easier. You got cash or you're about to, so you debit cash or accounts receivable, and you made some money, so you credit a revenue account like byproduct revenue or something. That's it. Debit to increase your assets, credit to increase your income. Perfectly balanced, so clean, so simple. It's totally exam-proof.
So you've got this revenue now. Where does it actually go on the income statement? Well, you've got 3 main choices. 1, you can just add it to your other sales at the top. 2, you can list it down below as other income. Or 3, and this one's a really popular move, you can use it to reduce the cost of goods sold of your main product. And why would you do that? Well, it makes your main product look even more profitable, which is pretty cool. The choice really just depends on the company and how much money we're actually talking about here.
I know what you're thinking. This seems way too easy for an accounting topic, right? So why would a company pick this method? Well, the reasons are actually super practical and smart.
Okay, reason number 1, it's just plain simple. It saves a ton of time, a ton of effort, way less tracking, fewer calculations. Love that.
Reason 2 is all about materiality. Look, if the money you're getting from the byproduct is tiny compared to your main sales, it's just not worth the brain damage to do something more complicated. And last, sometimes it's just practical. Maybe you have no clue what the byproduct is even worth until someone actually offers to buy it.
All right, we've covered the what, the how, and the why. Now it's time to lock this stuff in for exam day. This is your LECPA brain hack. Ready?
Let's go rapid-fire review. What's the nickname? The Recognize It Later method. What's the core rule? Zero inventory cost assigned to byproducts. What's the trigger for a journal entry? Only the sale. What's the journal entry? Debit cash or AR, credit byproduct revenue. What are the 3 reporting options? Add to sales, other income, or a credit to COGS. And why do we use it? Simplicity and immateriality. Done. Seriously, screenshot this. This is your cheat sheet.
So there you have it. The sales method is simple. It's practical. But I'm going to leave you with one last thing to chew on, to really take your thinking to the next level. Imagine this. A company has a huge warehouse, just packed with the super valuable byproduct at the end of the year. But they haven't sold any of it yet. How could this so-called simple method actually make the company look less healthy than it really is? Think about it. What's missing from the asset side of their balance sheet? We'll get into that next time. See ya.